How SVB's CEO Greg Becker misled the public and the regulators about the bank's financial health and sold millions of dollars worth of stock before the collapse. Silicon Valley Bank was once the go-to bank for U.S. tech startups. It provided financing for almost half of U.S. venture-backed technology and healthcare companies. But in March 2023, it collapsed in a matter of days, marking the largest bank failure since the 2008 financial crisis. How did this happen? And what role did SVB's CEO Greg Becker play in this disaster? In this video, we will expose how Becker misled the public and the regulators about the bank's financial health and sold millions of dollars worth of stock before the collapse. One of the main reasons behind SVB's downfall was its risky investment strategy. Instead of investing all of its deposits into other startups or venture firms, the bank placed a sizable share of the funds into long-term treasury bonds and mortgage bonds, which typically deliver small but reliable returns amid low interest rates. But when the Federal Reserve began raising interest rates a year ago to tame inflation, these bonds lost significant value. SVB announced a $1.8 billion loss on the sale of securities, including these bonds, on March 8, 2023. This triggered a panic among SVB's depositors, who were mostly venture capital firms and tech startups. They began to withdraw their funds from the bank, fearing that it would run out of cash. This created a classic run on the bank, which SVB could not survive. But Becker did not warn the public or the regulators about this looming crisis. Instead, he tried to downplay the loss and reassure investors that the bank was well capitalized and had enough liquidity to meet its obligations. He also announced plans to raise more than $2 billion by issuing new shares and selling some assets. But this was too little, too late. The market did not buy his story and SVB's shares plummeted 60% on March 9. What's worse, Becker himself had sold millions of dollars worth of SVB stock before the collapse. According to SEC filings, he sold more than $10 million worth of shares between January and February 2023, when he presumably knew about the bank's deteriorating financial condition. This raises serious questions about whether Becker engaged in insider trading and violated his fiduciary duty to shareholders. He is now facing multiple lawsuits and investigations from regulators and law enforcement agencies. Becker has apologized for the bank's failure and claimed that no bank could have survived the unprecedented deposit run that led to SVB's collapse. But his apology rings hollow for many who lost their money and trust in him. SVB's collapse has shaken the U.S. banking system and exposed its vulnerabilities. It has also tarnished the reputation of Becker, who was once hailed as a visionary leader in the tech industry. He is now seen as a greedy and dishonest executive who betrayed his customers, investors, and employees.